Big tech and AI stocks have been moving markets in the last week, with names such as NVIDIA and Oracle dropping, while Google and Meta rose. Here to help us make sense of the moment is Nancy Tengler, CEO and Chief Investment Officer of asset manager Laffer Tengler Investments. Nancy, good to have you here.
Thanks for having me, Anita.
Nancy, it feels like the biggest name on tech investors' minds right now is really NVIDIA. So I want to start there. We saw the company's share price dip yesterday after the information reported that Google was in talks with Meta and other companies about letting them use Google's TPU chips in their data centers. And that could pose a challenge to NVIDIA. NVIDIA later put out a statement saying they're delighted by Google's success and they've made great advances, and that NVIDIA is a generation ahead of the industry. What are you making all of this? And do you see any one company kind of closing that gap with NVIDIA?
Yeah, except I don't think it's necessarily Google. It may, in fact, be AMD. But I will point out, Anita, that they also issued a similar statement after the DeepSeek situation. And so, what you have to look at with NVIDIA, I think, is really two things. Think of NVIDIA chips as the entrance into the ecosystem. Their software CUDA is really what uh, developers utilize to to develop programs. It's much like Apple's app store, where the cell phone is just the gateway, the smartphone. And so I think NVIDIA is, in fact, years ahead of all the nearest competitors. Now, the good news is one of our largest holdings in our ETF TGLR is Broadcom, and they are the ones that are designing and partnering with Gemini slash Alphabet on the TPUs. So I think there's plenty of room for a lot of winners in this environment. But right now the market's just it's focused on headlines.
And are you an owner of NVIDIA and AMD stock?
We are, and we own Apple and we own Google. So we own them in different strategies for different reasons. Google was actually added in our value portfolio first, and then we added it back into growth because remember, it was left for dead just a few short months ago. Nobody wanted to own it. It was the laggard in the Mag 7, and now it's the darling. I think we're going to see this leapfrogging for a number of months, maybe even years.
I guess speaking about names that are in your portfolio, Nancy, another name that I thought was interesting is Oracle. The stock is down some 30% in the last month. And I know investors have been really worried about the company's capital intensive push to turn from a software company to a cloud provider. I mean, we had a story yesterday about how Oracle and its construction lenders are borrowing huge amounts of money to fund that push. Yet you said that you bought Oracle shares yesterday. And I wanted to know why that is.
Yeah, well, a couple of reasons. Again, the headlines and the hedge funds and the algorithms are really driving short-term performance in this stock. But if you look at the debt to equity ratio, at the end of the quarter, it was 427%. That was down from 781% in August of 2024. Now they did go to the market for a bond offering that was 18 billion. That drove the debt to equity ratio up to 500%. But this is a company that has a long history with debt. And if you look at, people are lumping in the senior credit facilities, which are about 56 billion. They haven't drawn on those yet. And if you look at plant, property, and equipment, up 130% year over year, debt is only up 9%. So I think everyone needs to take a deep breath. The RPO backlog has already been taken out of the price of the stock. And that's why we thought, we were selling it in the low 300s in the summer, or actually in September. And then now we're buying it back. I mean, we still held it, but we're adding back to our holdings because we think it's been overdone.
And I guess zooming out bigger picture with Oracle, are you not concerned about its cash burn and its long-term future considering its push?
I am not concerned about that. What I am concerned about is the overdependence in this market, or the perceived overdependence to OpenAI. And that's something that I think is worth worrying about because that's a company that's got a burn rate and very low levels of revenues. Oracle has a number of businesses, and they will figure this out. Larry Ellison still owns 42% of the company. We talked to the company. They're going to defend their investment grade ratings. So I don't think Oracle's necessarily the big problem unless there's a problem with OpenAI. And then I think that impacts the entire space. But let's also remember that data center build out is dependent on, I think it's like between 100 and 5,000 employees to build a data center, Anita. And we've already got 450,000 manufacturing jobs that are unfilled. So you've got construction and manufacturing workers required in these data centers. That may slow down the build out just naturally. But in the meantime, Microsoft, Satya Nadella had said these data centers are fungible. We can use them for other things. So I think there's a desire to be panicked. I was managing money in the 90s. This is not that.
I do want to get to the AI bubble talks, but before we get there, just wanted to ask: is there anything else that you're buying? It sounds like you're an owner of many of the Mag Seven stocks, but what right now is speaking to you outside of Oracle?
Yeah, we're actually buying consumer discretionary, Anita. I think the One Big Beautiful Bill Act has not really been factored into most investors' thought process. 150 billion in additional tax refunds should be paid to U.S. taxpayers in the first quarter. That's for a total of over 500 billion. So we think the consumer discretionary names will benefit. We've been adding to TJ Maxx, TJX, and Ulta. ULTA, and there's other names in the space we like. We recently added to Starbucks. I think that's a good offset. And then one of our largest holdings is Walmart. And I think Walmart is interesting on so many levels. We bought it about, I don't know, 8 or 9 years ago. It has become the poster child of our investing theme, which is old economy companies embracing the new technologies. And Walmart is also, it just provides a lot of insight when you listen to management. They're only seeing about 1% inflation in their purchasing. So that's pretty compelling if you're also worried about the Fed and inflation and whether we're going to get a cut or not. So those are the names that we like in staples and in consumer discretionary.
Interesting. So I wanted to flip the conversation back to AI for a second. What is one AI stock or tech stock that has AI exposure that you're not optimistic about in today's market?
So we do not own Meta. We sold it at lower levels than it is today. We bought Spotify. This is the dilemma for every portfolio manager. You always look at what you sold and you go, but it kept going up. Well, Spotify went up a lot more, and that's how we have to console ourselves. We've been sort of circling the wagons around it, but I'm not ready to pull the trigger yet because the monetization of their AI spend is a little bit more difficult for us to wrap our brain around. So we've sort of stayed off to the sidelines and will continue to watch that one, but we don't own it currently.
So I've got to ask Nancy, I want to wrap this up by getting your thoughts on, are we in an AI bubble or not? And why or why not?
So I have been drawing the analogy to the 1990s, Anita, for 3 years because I was a portfolio manager then. And there are a lot of similarities: higher interest rates, higher inflation, productivity driven growth. But the companies that we were focused on in that, or at least that were driving the growth, had declining earnings. So the growth names had earnings were contracting while their valuations were soaring. That is not what we have today. The growth names that are driving this particular industrial technological revolution are generating about 20% growth on average in EPS. And then in addition to that, the CapEx spend in the 90s was it soared for the entire decade. We're just getting started. So I think we're in the beginning of the runway. This won't go on forever, but it will go on for some time. And I think for your viewers, you may want to just focus them on some of the second and third derivatives. One of the names that we own in our thematic portfolio is Symbotic, which has done all of the backroom automation for Walmart. They reported yesterday the stock was up 20%. Don't necessarily buy it today, but look for those kinds of names. I mean, the earnings growth in that name is going to be over 100%. And the adoption to robotics and back office automation or logistical automation is just getting started.
Well, Nancy, you are full of ideas, and there is never a dull day in the AI market. So thank you very much for coming on to the show today.
Thanks, Anita.